Macroeconomics for Investors. Chapter 6. Yield Curves. Section 1. What is a yield curve? A yield curve is simply a graph that shows bond yields across different maturities. The key idea is that the borrower stays the same, so what changes is mainly the length of time you are lending for. In practice, investors usually mean the U.S. Treasury yield curve because treasuries have very low default risk. That makes the curve a cleaner way to see what markets are demanding for short-term versus long-term lending. If the yield at 3 months differs from the yield at 10 or 30 years, the curve captures that difference in one picture. So at a glance, the yield curve is the market's price of time. Treasuries are commonly used because they help isolate maturity effects from credit effects. If you compare bonds from very different borrowers, part of the yield difference may come from default risk rather than from time to maturity. With treasuries, that credit risk problem is much smaller, so the curve is easier to interpret. Investors can focus more directly on questions like inflation expectations, future policy rates, and compensation for locking money up longer. If you mixed treasury bonds with risky corporate bonds, the signal would become muddy very quickly. So when people talk about the yield curve, they usually start with a same credit quality comparison for exactly that reason. Even when the borrower is the same, yields usually differ across maturities, because longer lending horizons come with more uncertainty. Inflation can erode the real value of the payments you receive far into the future. Longer-term bonds are also more sensitive to changes in interest rates, which means their prices can move more sharply. On top of that, your money is tied up for longer, so you give up flexibility. Investors often want extra compensation for taking those risks, and that extra compensation is called the term premium. This is one major reason long-term yields are often, though not always, above short-term yields. Once you plot yields across maturities, the curve usually falls into one of three broad shapes. A normal curve rises from left to right, meaning longer maturities offer higher yields. A flat curve shows very little difference between short-term and long-term yields. An inverted curve slopes downward, so short-term yields are above long-term yields. Those shapes matter because they summarize how the bond market is pricing current conditions and future expectations. Rather than looking at dozens of individual bond yields, investors can read the overall pattern through the shape of the curve. Each curve shape tends to suggest a different market story, although none of them give certainty. A normal curve usually means investors still want extra compensation for lending over longer periods, often in an environment of steady growth and manageable inflation. A flat curve can signal uncertainty, or a transition in policy and economic expectations. An inverted curve often suggests the market thinks future short-term rates will be lower than current short-term rates, which can happen when growth is expected to weaken. But it is important not to overstate any one shape. The curve offers clues, not guarantees. Building a yield curve is conceptually straightforward. You gather yields for bonds of the same credit quality across a range of maturities, such as 3 months, 2 years, 5 years, 10 years, and 30 years. You place maturity on the horizontal axis and yield on the vertical axis. Then you plot each bond's yield and connect the points to see the overall shape. Once that shape is visible, you can compare it with curves from earlier dates. That time comparison matters, because the change in the curve can be just as informative as the curve itself. Consider a simple treasury example. Suppose the 3-month yield is 4.45%, the 2-year yield is 4.10%, the 5-year yield is 3.90%, the 10-year yield is 3.80%, and the 30-year yield is 4.00%. Reading from left to right, the short end starts highest, and yields fall through the 10-year maturity. Then the 30-year yield turns slightly higher again. That means most of the curve is inverted, because shorter maturities are yielding more than intermediate and long maturities. Even so, the slight rise at the very long end tells us the market still demands some extra compensation for very long horizons. This example carries a very specific message. The 2-year yield is above the 10-year yield by 0.30 percentage points, or 30 basis points, which is a classic inversion signal. Markets may be saying that today's relatively high short-term rates are not expected to last. In other words, investors may believe future policy rates will be lower, perhaps because growth or inflation will cool. At the same time, the 30-year yield remains above the 10-year yield, suggesting there is still a positive premium for taking on very long-term uncertainty. So the curve is not saying only one thing, it is combining expectations about policy with compensation for time and risk. Investors watch the yield curve closely because it bundles several important macro signals into one market price. It reflects expectations for Federal Reserve policy, views about inflation, and broader growth concerns. It can also shift because investors are suddenly more eager to hold safe assets, which can push some treasury yields lower. And because bond prices move every day, the curve itself changes every day as well. That is why experienced investors rarely treat a single snapshot as enough. They watch how the curve evolves over time, and they read it alongside other economic information. There are a few common mistakes that are worth avoiding from the start. First, an inverted curve is not a guaranteed recession call. It is a warning signal, not certainty. Second, one bond's yield by itself is not a yield curve, because a curve requires multiple maturities. Third, a flat curve still carries information, often about uncertainty or transition, so it is not meaningless. And finally, always compare bonds of similar credit quality, or you can confuse maturity effects with credit risk effects. Good interpretation begins with knowing both what the curve can say and where its limits are. Section 2. Normal versus inverted curves. With that foundation in place, we can focus on the two curve shapes investors talk about most, normal and inverted. A normal curve slopes upward, meaning longer maturities yield more than shorter ones. An inverted curve slopes downward, meaning short-term yields are higher than long-term yields. In both cases, the comparison should be across bonds of the same credit quality, which is why treasuries are the standard example. The slope matters because it gives a quick read on how markets view growth, inflation, and future policy. In a single line, the bond market is expressing a broad set of expectations. A normal yield curve is the shape investors usually see most often. Short-term treasury yields are lower, and yields gradually rise as maturities extend further into the future. That upward slope reflects the fact that lending money for longer generally requires more compensation. It often appears during economic expansions, when growth is continuing and markets do not expect a sharp drop in policy rates. Even so, normal does not mean risk-free or unimportant. It simply means the market is pricing time in the usual direction. Why does a normal curve usually slope upward? Part of the answer is economic expectations. Markets may assume growth continues and inflation stays reasonably contained rather than collapsing. Part of the answer is compensation for uncertainty, because long bonds face more inflation risk, more interest rate risk, and more price sensitivity. Investors are locking money away for longer, so they often want a term premium in return. You can think of the long-term yield as including both an outlook for future short rates and an extra payment for bearing long-horizon uncertainty. When those forces work together, the curve tends to rise from left to right. An inverted yield curve is the less common shape, and it gets attention for a reason. In this case, short-term yields rise above long-term yields, so the curve slopes downward. That often happens after aggressive central bank rate hikes have pushed up the short end of the curve. If investors believe those high rates will eventually have to come down, long-term yields may stay below short-term yields. The market is effectively saying current policy looks tight relative to what it expects later. That is why inversion is often treated as a warning sign for weaker growth ahead, even though it is not a guarantee of recession. Inversions usually form through a combination of current policy and future expectations. The central bank raises short-term rates, and yields at the front end respond quickly. At the same time, investors may begin to expect slower growth, lower inflation, and eventual rate cuts. That expectation can pull down yields on longer maturities, especially if buyers want to lock in those yields before rates fall. Strong demand for long bonds can reinforce the move by pushing long yields even lower. The result is a curve that flips from its normal upward slope into a downward one. A helpful simplification is to say that the slope of the curve comes from two main drivers. One is expected future short-term rates. The other is the term premium, which is the extra yield investors may demand for holding longer maturities. Put together, long yields are often described as expected future short rates plus term premium. When a curve inverts, That often means expectations for future short rates have fallen enough to outweigh the usual upward pull from the term premium. So inversion is often less about the premium disappearing entirely and more about the market expecting policy rates to decline later. A practical reading starts at the short end, because that part of the curve is closely tied to current central bank policy. Then compare those short maturity yields with yields on 10-year or 30-year bonds, which reflect longer run expectations and term premium. If long yields are clearly above short yields, the slope is positive. If the difference is tiny, the curve is flat. If long yields fall below short yields, the spread is negative and the curve is inverted. Watching the curve move from positive to flat to negative can be especially useful because flattening often comes before inversion. The 10-year minus 2-year spread is a common way to measure that slope. If the 2-year yield is 4.20% and the 10-year yield is 3.85%, then 10-year minus 2-year equals negative 0.35% or negative 35 basis points. That is an inversion because the long yield is below the short yield. Later, if the 2-year falls to 3.60% while the 10-year is 3.90%, the spread becomes positive 0.30% or 30 basis points. That would mean the curve has returned to a more normal upward slope. This kind of simple subtraction turns the shape of the curve into a number you can track over time. Even though curve shape matters, it should be used carefully. An inversion is best understood as a warning, not a clock telling you exactly when weakness will appear. A flat curve is also not the same as an inverted one, because the market message is usually less severe and more ambiguous, and one spread by itself does not tell the whole story, since different parts of the curve can behave differently. On top of that, expectations can change quickly as inflation, jobs data, or central bank communication shifts. So the most reliable approach is to use the curve as one strong signal within a broader macro process. One simple way to improve your read is to compare more than one spread. For example, calculate the 10-year minus 3-month spread, and then compare it with the 10-year minus 2-year spread. Sometimes those two measures point in the same direction, and sometimes they do not. If the 3-month to 10-year measure is inverted while the 2-year to 10-year measure is still positive, the market may be sending a more nuanced message about near-term policy versus the medium-term outlook. The short end is especially sensitive to current policy settings, while the 2-year embeds more expectations about where policy may go. Looking at both spreads helps you see more of the curve's story. Section 3. Bond market expectations. The yield curve matters because it is a market-based summary of collective expectations. Thousands of investors are constantly trading bonds based on their views of future policy, inflation, and growth, and those views become visible in yields across maturities. Instead of reading every individual trade, we can observe the curve those trades produce. That makes the yield curve a practical way to monitor what the market is pricing in. But it is still only one signal, not a complete explanation of the economy. It is most useful when combined with other evidence. A simple expectations view says that a long-term yield can be broken into two parts. One part reflects the short-term interest rates investors expect to prevail over the life of the bond. The other part is the term premium, the extra compensation for holding a longer maturity. That framework helps explain why policy expectations can reshape the curve so quickly. If markets start expecting the central bank to cut rates later, long-term yields may fall even if current short rates are still high. It is not a perfect theory, but it is a very useful starting point for reading the bond market's message. Curve shape becomes easier to interpret once you think in terms of expected future short rates. If investors expect short-term rates to rise over time, longer yields often sit above current short yields, producing an upward slope. If they expect rates to fall later, the curve can flatten or even invert. That is one reason inversion is often linked to concerns about weaker growth and later policy easing. Still, the curve is not a mechanical recession switch. It is showing what the market is pricing, not guaranteeing what must happen. It is important to remember that the yield curve is not a pure forecast of future policy. Long-term yields also move when term premiums change, when inflation uncertainty rises, or when investors rush into safe assets. Heavy demand for long treasuries can flatten the curve even if the outlook for growth has not changed very much. At the front end, liquidity and funding conditions can distort very short maturities. So if the curve moves, The right question is not just what markets expect about rates. The better question is which combination of expectations, premiums, demand, and market plumbing is driving that move. One tool that helps sharpen the message is the implied forward rate. Forward rates translate today's curve into the rate the market is effectively pricing for a future borrowing or investing period. If a forward rate sits above today's short rate, that usually suggests the market is pricing tighter conditions ahead. If it sits below today's short rate, that suggests expected easing. This can make the curve's information more concrete because it converts shape into a sequence of market-implied future rates. Even so, these are implied prices from today's market, not guaranteed outcomes. To calculate a one-period forward rate, analysts usually start with zero coupon spot rates, because coupon bonds can muddy the comparison. The idea is to equate two investment paths that end with the same value. One path is investing for the full longer maturity at the longer spot rate. The other is investing for the shorter period at the shorter spot rate and then rolling into the forward period at an unknown forward rate. With annual compounding, that gives the formula where the longer spot return equals the shorter spot return times 1 plus the forward rate. Rearranging that equation solves for the implied forward rate. Here's a simple example. Suppose the 1-year spot yield is 4.0%, the 2-year spot yield is 4.5%, and the 3-year spot yield is 4.8%. From those spot rates, the implied forward rate for year 2 comes out around 50%, and the implied forward rate for year 3 comes out around 542%. Both are above the current 1-year spot yield. That pattern suggests the market is pricing higher short-term rates ahead. But as always, some part of that signal may reflect changing term premiums rather than a clean forecast. Forward rates are powerful because they turn a static curve into a path of market-implied future rates. But they still need to be handled with caution. They are not exact forecasts, and term premiums can bias what looks like a policy signal. Small movements in the curve can also be noise rather than a meaningful shift in outlook. That is why investors cross-check forward rate signals against inflation data, labor market data, and central bank communication. Forward rates are best used as a strong input, not as a standalone answer. Section 4. Yield spreads. A yield spread is simply the difference between the yields of two bonds. That difference helps investors compare how the market is pricing risk, time, or relative value. For instance, if a corporate bond yields more than a treasury, the spread shows the extra compensation investors demand to hold the riskier bond. Spreads are also useful within the yield curve itself, such as comparing the 10-year treasury yield with the 2-year treasury yield. In that sense, spreads give us a compact way to compare bond market signals. They turn broad relationships into numbers we can track. One of the most common spread comparisons is a corporate bond versus a treasury of the same maturity. Matching maturities matters because otherwise you mix credit differences with time to maturity differences. If a 10-year corporate bond yields 5.2% and a 10-year corporate yields 3.8%, the 1.4 percentage point gap is the spread. That spread reflects added credit risk, but it may also include liquidity differences and other market forces. The Treasury serves as the benchmark because it is generally treated as having minimal default risk. Good spread analysis always begins by stating that benchmark clearly. Spreads are often quoted in basis points because bond investors deal with small yield changes all the time. 1 basis point is 1/100th of a percentage point, or 0.001%. That means 100 basis points equals 100%. So if one bond yields 5% and another yields 4.0%, the spread is 5 percentage points. In market language, that is 150 basis points. Using basis points makes small differences easier to compare, discuss, and track over time. A spread does not reflect only default risk. Credit risk is one driver because investors demand more yield if they think payments are less certain. Liquidity matters too, since a bond that is harder to trade may need to offer extra yield. Maturity differences can widen spreads because longer horizons involve more uncertainty, and market sentiment also plays a role. When investors become more risk-averse, spreads often widen even without a dramatic change in fundamentals. So a spread is best thought of as a bundle of market judgments, not a single pure measure. There are several important kinds of yield spreads. and each answers a different question. Credit spreads compare bonds with different credit quality, such as corporates versus treasuries. Sector spreads compare different parts of the market, such as financial bonds versus industrial bonds. Term spreads compare different maturities, often within treasuries, and are central to reading the slope of the yield curve. That last category is especially useful in macroanalysis because it links bond pricing to growth and policy expectations. The key is to choose the spread that matches the question you are trying to answer. Calculating a spread is simple, but choosing the right comparison is the real skill. First, decide which two bonds are relevant to your question. Then find their current market yields and subtract the benchmark yield from the other yield. If helpful, convert the result into basis points. After that, interpret the number in context. A wider credit spread may suggest more perceived risk, while a narrower term spread may suggest the curve is flattening. Take a credit spread example. Suppose a 5-year treasury yields 3.0% and a 5-year technology company bond yields 2%. The spread is 2 percentage points or 120 basis points. Later, if the treasury yield falls to 8%, while the company bond yield rises to 8%, the spread widens to 0 percentage points or 200 basis points. That widening usually means the market now demands much more yield to hold the company bond relative to treasuries. In practical terms, investors are perceiving higher credit risk, lower liquidity, or a more risk-averse environment. Term spreads work differently because both bonds usually have the same credit quality but different maturities. Suppose the 10-year treasury yields 3.6% and the 2-year yields 3.1%. The spread is positive 0.5% or 50 basis points, which indicates a normal upward slope. Later, if the 10-year falls to 3%, which indicates a normal upward slope. Later, if the 10-year falls to 3%, and the 2-year rises to 2%, the spread shrinks to only 10 basis points. That narrowing means the curve is flattening. If the spread were to turn negative, the curve would be inverted. The meaning of widening or narrowing depends on which spread you are studying. Wider credit spreads often point to more risk aversion, tighter financial conditions, or weaker confidence in borrowers. Narrower credit spreads usually suggest greater comfort with risk. Narrower term spreads, by contrast, mean the yield curve is becoming flatter. If a term spread goes negative, that is an inversion. And in all cases, it is worth remembering that spreads can move for more than one reason, including policy changes, technical demand, and shifts in inflation expectations. Tracking a term spread over time can reveal a changing macro picture more clearly than looking at one date alone. If 10-year minus 2-year is 140 basis points on January 5, then 115 basis points on January 12, and 85 basis points on January 19, the message is straightforward. The spread is narrowing steadily. That points to a flattening yield curve, which may reflect expectations of slower growth, lower inflation, or lower future policy rates. The exact cause still requires interpretation, but the directional change is clear. Time series often make the signal easier to trust than a single snapshot. Spread analysis is useful, but a few mistakes can easily lead you astray. Do not assume a widening spread means improving conditions. Often it means the market wants more compensation for risk. Do not compare bonds with mismatched maturities if your goal is to isolate credit risk. Do not ignore liquidity differences, because illiquid bonds can look riskier simply because they trade poorly. And always use yields rather than coupon rates, since coupons do not reflect current market pricing. Clear comparisons and clear benchmarks are what make spread analysis reliable. Section 5. Recession Signals. An inverted yield curve gets so much attention because it often reflects a specific macro combination. Short-term yields move above long-term yields, reversing the usual upward sloping shape. That often happens when current policy is tight and markets expect weaker growth ahead. Lower future inflation is usually part of that story as well. In effect, the market may be saying that today's high short-term rates are unlikely to be sustained. That is why inversion is often treated as a recession warning, even though it is not a certainty. The most widely watched recession signal from the curve is the 10-year Treasury yield minus the 2-year Treasury yield. The calculation is simple. Take the 10-year yield and subtract the 2-year yield. If the result is negative, the curve is inverted at that part of the maturity spectrum. Investors watch this measure because it has often turned negative before recessions. Historically, the lead time has often been somewhere in the range of 6 to 24 months. That makes it a useful monitoring tool, but not a countdown clock. Not every inversion means the same thing. Depth matters, meaning how far below zero the spread falls. Duration matters too, meaning how long the spread stays below zero. A one-day dip to negative 10 basis points may be little more than noise or a technical market move. A deeper inversion, such as negative 50 basis points lasting for months, tends to carry more weight. Investors pay more attention to persistent signals because they are less likely to be accidental. In yield curve analysis, persistence often tells you more than the first crossing below zero. A subtle but important point is that the recession signal can actually strengthen after the initial inversion. Once the curve has stayed inverted for a while, investors watch for re-steepening, where the spread starts moving back toward zero. That change often happens because short-term yields begin to fall as markets price in future rate cuts. If weakening economic data is arriving at the same time, the warning can become more meaningful. So the key signal is not always the first inversion itself. Often the clearer message comes from the sequence of inversion, persistence, and then re-steepening. Still, not all re-steepening is recessionary. A curve can steepen because long-term yields are rising faster than short-term yields, which is often called a bear steepener. That kind of move may reflect inflation fears, stronger growth, or concerns that the central bank will have to keep policy tight for longer. By contrast, steepening after a long inversion often comes from falling short-term yields and expected policy cuts, which can reinforce a recession warning. So a steeper curve by itself is not enough information. The reason for the steepening matters at least as much as the steepening itself. This is why the curve is best used as a process rather than a one-day headline. Start by tracking the 10-year minus 2-year spread over time. Then ask whether the inversion persists for weeks or months and how deep it becomes. If the curve begins to steepen again, ask whether that move reflects falling short rates, rising long rates, or both. Then, compare the curve's message with other macro indicators. The quality of the recession signal comes from the sequence and the context, not from a single date. The yield curve becomes much more convincing when other indicators confirm the same story. Tighter credit conditions suggest banks and markets are becoming less willing to extend risk. Weaker consumer confidence can signal softer future spending. Softer corporate earnings point to pressure on business activity, while rising jobless claims hint at labor market deterioration. Slower housing activity can reinforce the idea that interest-sensitive sectors are weakening. When several of these measures line up with an inverted curve, the recession signal carries more weight. The period before the 2007 to 2008 recession illustrates the usual pattern clearly. The 10-year minus 2-year spread flattened sharply in late 2005 and turned negative in 2006. The inversion then persisted for an extended period, which made the signal more meaningful. In 2007, the curve steepened again as conditions deteriorated and markets anticipated easier policy. The recession officially began in December 2007, well after the first inversion. That sequence shows why investors watch not just inversion, but also duration and re-steepening. The 2019 to 2020 episode followed a similar pattern, but with an unusual ending. The 10-year minus 2-year spread inverted in August 2019, and the initial move was shallow, around negative 5 basis points. By early 2020, the inversion had deepened more noticeably. Under normal circumstances, investors might have expected a longer lag before recession. Instead, the COVID shock abruptly shortened that timeline. Even so, the inversion had still been signaling underlying vulnerability before the external shock arrived. A simple exercise helps tie the ideas together. Suppose the spread is negative 30 basis points on January 15 and still negative 30 basis points on February 10, then turns positive 5 basis points by March 1. That means the curve inverted and then re-steepened, but because the inversion lasted only briefly, the signal is relatively weak compared with a deeper inversion that persisted for months. The right lesson is not to overreact to the first negative reading or the first positive one afterward. Read the pattern as a whole and give more weight to depth, duration, and confirmation from other data.